most stocks are going down. So true diversification for me is diversifying across not just the stock market, but into other asset classes. So it could be global indices, it could be foreign exchange, it could be fixed interest markets, it could be commodities markets. Now, here in Australia, most investors have a view on commodities, whether it be the price of copper or nickel, oil or natural gas, or even something like wheat. The great thing is you can trade all of these things with a CFD product on the Think Markets platform. We've got over 4,100 securities there to choose from, and you can go long and short. So it doesn't just have to be a case of, I think this is going up. You might have an idea that something is going down as well. Sounds all pretty complicated, but in most cases it's as simple as finding the security on the platform and clicking the buy or the sell button.
Talking about the platform, where can investors go to find this information?
Yeah, well, obviously head to thinkmarkets.com/au, where we've got all of the information on how to set up an account. Once you do have an account set up, we do have some really fantastic platforms that you can use that have the live prices and even live news feeds to give you all the information you need to make informed decisions as to what to trade.
With Think Markets, you can trade ASX shares as well as CFDs on FX, indices, commodities, crypto, and more. Head to thinkmarkets.com/au.
The Small Caps is partnered with the Australian Stock Report. Looking to make better investment decisions? Visit australianstockreport.com.au.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.
Hello and welcome to The Call, 10 stocks picked by you. Two experts, 1 hour. It is Friday the 9th of September. I'm Andrew Gagan. Good to have you with us. Our experts today, Adam Dawes from Shaw & Partners and Mark Gardner from Marqo Captial. Welcome to both of you guys. Not a bad morning on the market. I'm just looking at what's moving at the moment. My goodness, lithium, it just Yeah, well, no, not all stocks though, Adam, so don't get too excited.
No, but mineral resources.
Well, mineral resources, which of course it's not, well, it has a stake in lithium, but it's saying, what is this based on the fact of saying no definitive plans to list its lithium business? Its shares are up 11%.
Yeah, so I've had 3 clients call me today and saying, why is mineral resources up when they've said no to a potential listing of the lithium business? I think that the market doesn't believe that they aren't looking at listing their lithium business. So I think that's what the market's getting behind. And if you look into the wording, it does say that we have looked at some strategic positioning, but we don't think it's material enough to mention it to the market. So that's sort of, it's not a definitive no, but it's not a definitive yes as well. So I think the market doesn't believe them, and it potentially might be looking at a listing further on down the track.
Mark, I know we've spoken about lithium stocks before. I mean, how do you look at MinRes in that space then?
There could be another reason for that, because I do believe a competitor station this morning may have, when I was listening as I was writing the morning report, actually reported that as they were doing it, and then I think then corrected themselves. So that may be another reason why someone's picked up the story, because that's how I heard it initially. Look, lithium, as far as we had a lot of Alchem PLS.
That you sold.
We're out, yeah. Well, for now, I think we'll probably get them lower again. We're certainly looking to buy back in. I did not expect a 9-week rally to equal to be 110 odd percent, which for me now really sort of looks a little bit frothy overall. So
it'd be interesting to see where they're starting to tip, because we've got Liontown down close to 5% today. Core is also down. Yet Pilbara is still going.
Well, that's the joy of 95 odd percent margins on your product. So I think there was a report from Macquarie saying, I think they've got a price target of about $5.60, saying that these soon-to-be producers are nowhere near as going to be coming online nowhere near as quickly as what everyone's saying they are. Yeah. So that that deficit. So Alchem and PLS, I think particularly, will they're going to really make hay while the sun shines. I've switched, to try and stick in the battery play at nickel mines is quite cheap at the moment, just to try and have an interest in still. So it's been battered down for no particular reason at all. There's been a sort of fairly large sell order in the market the last couple of days. It seems to be finishing up. So hopefully that'll start to pick up, and that already pays a decent dividend. The outlook's pretty good. So.
Yeah, well, plenty of spaces to look in the battery metals space. All right, let's take a look at what you guys want to hear from us today. The first 5: Goodman Group, News Corp, Telstra, Apollo, and Centuria Industrial REIT. Our stock of the day is Ramsay Health Care. Now, there's a bit of news about here saying its talks to sell its Malaysian joint venture are over, with the potential suitor walking away from its indicative proposal valuing the business at $1.83 billion. This is the Sime Darby Holdings to IAH Healthcare. So that's fallen through. It did not result in a binding agreement. But I guess the broader interest in Ramsay is all about that potential takeover from KKR, which also fell through. But perhaps a thought there, Adam, that they're going to come back.
Yeah, well, KKR obviously put more conditions around that bid, and that obviously has then seen the share price consolidate a little bit around here. The JV, obviously, that JV in Malaysia is over. That's not a great sign. I think Ramsay Health Care is trying to clean up their book, trying to get rid of some non-core assets, and that certainly isn't going to be great for them going forward as well. But looking like at the share price there, it doesn't look too bad.
It's back to its average, really. Isn't it?
So I mean, if you think KKR is going to come back in with a higher bid or less conditions, potentially Ramsay is a buy down here at these levels, because looking on a historical level, I think that's exactly if it can hold this sort of $70, basically it's going to stay here and potentially go higher. I'd be comfortable to hold on to Ramsay. I don't think it's a buy. I think they've got to get through some of this stuff and get KKR out of the way, or at least clear it up so that shareholders can get a clear direction on what's going to happen.
Mark, when you look at a stock like Ramsay as potential takeover is that worth looking at when you look at perhaps a company and think, well, it is a a takeover target, therefore it's worth having a punt?
It depends on the situation. A situation like Oz Minerals, for instance, I think it's probably not, because I think BHP is pretty much the only person or the only company that's going to be able to buy it, and it was comfortably trading 40% lower beforehand. Whereas this, at the moment, where it stands, it is back to sort of the average price. We're holders of it, more so just with the recent volatility, obviously market fluctuations. We want to put some healthcare into portfolios which are non-cyclical. I mean, that previous bid, I think, still was at the $88 mark for shareholders under 5,000 shares. So I think it's around the 300 grand mark or something like that. So, you know, there's still obviously interest there. It's a big, complicated business. So we're pretty happy to absorb or accumulate around this level here as it stands at the moment. Just on the back of the safety of it. I mean, realistically, it's not going to fall back a hell of a long way. If there is absolutely both parties walk away from the table, but there is good upside there. It yields okay, and as I said, I don't think we're quite through the the market turmoil. I know we've had a fairly buoyant, say, sort of 8 weeks, but. It's only going to take a high inflation number next week, and all of a sudden panic will set in again, or a Australian missile supposed to go over Taiwan doesn't go over Taiwan, or something like that. So we're still sort of looking at a little bit of safety. So and this one has it for us, and it's a high quality business as well. So yeah, we're a buy here at 70.
Okay, in fact you're accumulating.
Or accumulate, yeah.
Fair enough. All right. Let's get into those stocks as picked by you. Our first one, Goodman Group. Dean wanted to know about this. It is the integrated commercial industrial property group. Owns, develops, manages real estate, warehouses, logistics facilities, and office parks on a global front. Mark, just taking a look at the share price, it has been disappointing. It's off around 15% for the year, despite what we're seeing in that space at the moment.
Yeah, I think Goodman's got a little bit of development in it as well, and obviously that's probably hurt it a lot. It doesn't yield a lot either. It's significantly lower than the industry sector. It's average yield around sort of 5.6%. At this price, though, I mean they're great management. Historically, very low PE. Towards the start of the year at those highs, PE was sort of in the low 20s. It's now more around 11 or 12. So our preferred choice in this space at the moment, again, just being a little bit more conservative, is CIP, which we've got coming up later on. But this is one that when we get a little bit more clarity on the macro outlook and the economic cycle, etc., then it's certainly one that we'll be picking up, because it does tend to run harder to the upside. If you compared that to CIP, for instance, it is the much more aggressive play. So, and at this point in time, it's aggression's not really in our arsenal. We're just sort of happy to take the extra dividend yield, etc. But they've got high occupancy, 99%. Their margins are great. They've always performed well. So yeah, it'll be a buy on dips for us.
Okay, Adam.
I'm going to disagree. I think it's a buy all day long. Very comfortable with Goodman Group. I don't really like CIP, so we'll see how we go on that other side. But yeah, look, absolutely. The reason I think the stock price has come back a little bit, obviously it gets thrown in the bucket with real estate or REITs. It means that higher interest rates potentially has a bit of an issue with that. Dividend yield, yeah, is pretty anemic, but overall their rate expansion's looking good. Near term, they've got performance fees that they can pull on. They've got market rent growth, as well as they've got a healthy work in progress or strong tailwinds that are going forward as well. Another reason why I think the share price has come off a little bit, Goodman Group actually came out and said that the guidance for 2023 was going to be a little bit conservative. Now, Macquarie Bank does this regularly. They talk it down, but then they are able to talk it up at the end of the year, and I think that's exactly what these guys are doing. We still see that 2023 looks very much intact. Lots of rent, as you say, weighted average lease and occupancy at 99%. So there's basically nothing around. They're going to be building some more parks, and I think that's the thing, is going to be tough for them to find good sites, and then cost of those sites, so that might drag on the overall capital expenditure. But overall, it's a fantastic business and I like it. I would be buying it down at these levels, no problem.
All right.
Yeah, there's a great stat with the amount of industrial real estate that's needed for the next 5 years is something like 3 million square metres, and there's only applications or plans for about 1 million. So, but I mean, look, either or, realistically, it's we play this between CIP and Goodman's back and forth quite a bit sometimes. But that entire space really has tailwinds for quite some time.
All right, well, we'll expand on that very shortly because we are going to take a look at Centuria in a moment. First, though, next one we're taking a look at is News Corp. Max wanting to know about this, its results, 11% increase in full-year revenue, and net income up 95%. In fact, Adam, in the news business, of course, and I guess got to look at ad revenue at the moment in the face of rising inflation and interest rates.
Well, it's interesting and a great segue because I was just about to talk about ad revenue. So perfect. But yeah, less cyclical than expected. I'm going to start again. News Corp revenues are spread across a fair few part of their divisions. So Foxtel, Dow Jones, and all of their news media as well. But advertising revenue only comprised of 16% in 2022. So there's a lot of other levers that these guys can pull, illustrating that there's a bit of a transition, I think, that the group's going through. Remember, they do hold fairly substantial holdings in REA, about 60% of REA, and they've got no intentions of taking that over. Pulling the sum of parts, actually, News Corp doesn't look too bad. I'm never a fan of media, and I've been sort of fairly vocal about that as well. But it's not just media, News Corp. They've got a lot of other things going on. So for me down here, I actually don't mind it at $25. I think that their results are going to beat expectations. So I'm going to say that I'll be comfortable with a buy on News Corp.
Okay. Mark, do you agree?
Yeah, I do agree. I think the analysts have been pretty heavy-handed or dour on the media sector altogether, really. I think Seven West Media has done quite well. Nine's one of our holdings. It's yielding the highest. It's yielded for quite some time. The lowest PE as well. We're next divvy today, but similar to what Adam's saying about they've spread their business out now. Like Nine's 46% in is more online. Obviously, News Corp, doing the same thing. So it's not as prone to the economic cycle as it used to be. And I think quite a few of these analysts probably, maybe need to update their models on the compositions of these businesses because they're sort of being painted with a brush that's a little bit prehistoric. These businesses have gone to great efforts to change over the last 5 years. They were heavily criticised and they've come out the other side, fairly well, most of them. So I think an upside target on this one's like 33, I think, consensus.
Yeah.
So, but yeah, if you're looking at, if you want a higher yield, Nine's around about sort of the 7% mark, and a low PE. This one, similar PE, slightly less on the yield, but possibly a little bit more upside and a little bit more global exposure.
So you are
a buyer, yeah.
Yes. All right. That is News Corp. All right, let's move on to Telstra. We know what it does. Brian wanting to know about this. And in fact, change at the top because Andy Penn has signed off. In fact, in his departure, he said he's simplified the business, digitised it, complaints have more than halved, and we've improved the financial trajectory of the business, and we're delivering some great tech solutions, replaced by the CFO, Vicky Brady. Mark, how does this make a difference to a business when you've got such a significant change at the top there?
Well, Andy Penn's done a fairly good job. I was on when I think the last time we had this stock on the call, and he was interviewed beforehand. So, and it was about the most enthusiastic I've been about Telstra for quite some time. But look, it's not really something, it's dividend payout ratios are sort of creeping into, they're sort of paying out a little bit more than what they're earning. Their earnings per share was less than their dividend per share. we've obviously. I think it's a good thing that they've brought people internally in to to continue his work, and obviously that should smooth out the management changeover. But it doesn't really yield enough. It's a pretty it's just a behemoth of a business that it doesn't. It's getting more agile, and but I'd probably just want to wait and see. I think there's much better places to have your money put at the moment. Getting better yields on lower PEs that are just as stable generally. So yeah, and look, if you want something in the communications sector, I think Aussie Broadband's quite cheap at the moment as well. So there's an opportunity there in terms of share price, not in terms of dividends. So
you're saying you effectively still wasting your time holding it then?
I don't think the return on equity's been that fantastic, to be honest. Over the last sort of 10 years, it's gone sideways forever. So it looked great when the market was getting hammered, if you're going to use it as a benchmark, but that's about it really for me. But yeah, it's not really something that I tend to hold. It's we get any portfolios come in, it's one of the first things I'll sort of get rid of and shift it to something else.
I'm taking that as a sell then.
Yeah.
Okay, Adam.
Yeah, look, I'm going to stay neutral on it or a hold. I do have a lot of clients with Telstra, and they're all about that income, and I sort of at pains to tell them that income has been reduced so many times over the last 10 years. It's been reduced. So I think Telstra last half actually upped their dividend a little bit, which I think everybody got really excited about, and then and now started to come back. It was over $4 and then sort of started to come back. But on to Mark's point, ROEs at 11 times, that's nothing to be writing home about. You want businesses with sort of 18 to 20 times ROE. So really that return on equity is not that great. Dividend yield of 4%, 100% franking, so it's not too bad. They did start talking about some other themes that they want to bring out to the business or wanted to bring out to customers, and that's the Internet of Things. We've all heard that story. It's you're not telling us anything new here, Telstra. And they're talking about innovation of connectivity. So in other words, their healthcare businesses and all those kinds of things moving forward. So it's really not an exciting stock. It's really nothing that you sort of can see some real big movements in. But a lot of clients, it's very difficult to get them to sell. I'm neutral on the story. I'm certainly not putting any fresh money in it. And any client that does have it, we are trying to reduce their weightings in it. But yeah, for me, I'll be a hold on it at the moment.
Do you like any other telcos?
I love Aussie Broadband, and we bought very low. We rode it all the way up. I tried to get clients to take some profit, sell. We're back down here again. We're accumulating Aussie Broadband down here as well. It's in a bit of trouble, but I think it's going to be okay.
All right. Let's hit the road with Apollo. Dean, wanting to know about this. It rents, sells, distributes recreational vehicles, of course, which was all the rage during COVID. Remains to be seen, I guess, whether that momentum is going to continue. In fact, it is planning a merger with Tourism Holdings, but that's subject to the ACCC taking a good look at that. So, Adam, what are your thoughts on Apollo?
So first of all, for any investors out there, well, hopefully they're all investors out there, but for the investors out there, is basically looking at businesses that are having a COVID hangover. So the likes of Domino's, Temple and Webster, there's plenty of them out there that were real big beneficiaries of COVID because of their business model and everything that happened. So what's happening now is we've got this massive hangover, and you can see Domino's share price, rallied to $150 and it's back down to wherever it is, 80, whatever it is today. That's that hangover now, or those businesses unwinding from that such a potentially higher profitability when everybody was locked down. Then there was the reopening trade, and everybody was sort of going, okay, well, let's buy Qantas, let's buy Webjet, let's buy Flight Centre, because it's a reopening trade. That trade is now also gone from here. So for me, this one is a sell. I think it is going to continue to be one of those hangovers of that COVID, as well as that reopening trade, which is all but gone. It is going to be tough. They have got some government assistance. I saw that they've received $25 million in assistance from governments. But for me, caravans just don't really do it for me. So I'm going to say...
You're not at that age yet, clearly.
I mean, I've got grey hair, but
no nomad.
No nomad at the moment. But you could spend $100,000 on a caravan these days.
Yeah, and then some.
And then some. There you go. So, maybe. But I think it's a tough year for travel-related companies like this one. and it's that unwinding of that COVID hangover that I think you just don't need to be around.
All right, Mark.
Yeah, I agree to sell. I mean, in terms of COVID hangovers, I mean, this company barely had a drink and still got a hangover. To be honest, it didn't. It should have performed well when it, over that COVID period. There was backlogs for caravans, etc. So, it just didn't really make a hell of a lot of money, if any money at all. To be honest, I don't really see where the analysts are seeing the upside here. It's fairly close to analyst price target around 60. So, I really don't see see it improving. Management just had an opportunity of a lifetime for that business, and it didn't perform. So, if you can't execute when everything's in your favour, then I certainly wouldn't be holding this business. And look, people are going to be going overseas now. They can. I think the Australian government, we removed the masks on planes rule, etc. I don't know how much of a difference that'll necessarily make, but this is definitely a sell for me. I really can't see it turning anything around. The merger is probably the best thing for it.
Yep. Okay, that is emphatic. It is a double sell. All right, let's get back into REIT. So this was mentioned before. Centuria Industrial REIT. Lewis wanting to know about this. So, Mark, here's your opportunity to pick up on what you were talking about earlier.
Yeah, look, it goes back to that demand, and I think that we've also got expectations of industrial rents, going up by about 50% over the next 5 years. Obviously, this has been hit quite hard. It's trading at a discount to NTA around about 28%. That's pretty sector wide. But more to Adam's point though, is that the whole REIT sector, I think it was one of the first rate hikes, just got absolutely hammered.
It happens every time.
And it didn't matter.
Yep.
It didn't matter, what subsector you were in. And I think
in fact, May it fell off the cliff.
It just fell off a cliff. So, and we all knew rate hikes were coming. I'm not entirely sure why. And obviously it's hit stops, etc. But look, this one yields quite well. It's trading below NTA. It's got a long WALE, around about 9 or 10 years. And it'll just be a steady performer, I think, overall. And like I said before, we tend to switch back and forth a little bit from this and Goodman's. When we sort of start to see the outlook clear up and have a bit more certainty, we'll probably be switching back into some Goodmans, because I think the development part of it will help kick that along, and they're good operators. So, but at the moment, this one just chips along with a nice quarterly yield. A lot of our clients quite like that quarterly yield as well. They're retired, self-managed super style investors. So. It's just nice getting a little divvy paid every quarter. I think they reaffirmed that today, and I think their earnings per share are looking at they're expected to sort of double over the next 12 months. So it's absolutely a buy for me.
All right, okay, Adam.
So I'm going to say, if you got it, I think it's fine. So it's going to be a hold. For me, I always like to be in the number one business or the number one company in the space that it's in. And you sort of learn that from, potentially the buy now, pay later businesses, where Afterpay was the one that, really basically outstripped everything else. And the second and third and fourth and fifth tier guys just always got, hammered. So Goodman Group is the one who is the number one in the space and is the leader. And that's where I want to be. CIP does okay because it is quite diversified. They've got 88 assets and around about $4.1 billion of assets inside of that. And it's quite interesting how they've got distribution centres, transport and logistics, data centres and cold storage. A couple of things about the data centre side of things and cold storage. They'd be paying a little bit extra for energy, which is obviously going to be something that they'll have to sort of offset. Other places, and we saw NextDC, those kinds of businesses getting hit a little bit hard on those side of things. But good diversification, gearing only 33%. That's actually quite good. Gearing for a property trust can be up to sort of 40 to 50% depending on their range. So they do have some money that they can gear and then potentially find some more sites. But again, it comes back to there's no free flow of property anywhere in the major centres of Sydney and Melbourne. And those assets are really hard to come by and you have to pay up for them. So they've got to be careful. I'd stay with Goodman. It'll be a hold on COP for me.
Very good. Okay, let's sum up where we've been for the first half of the show. Our stock of the day was Ramsay Health Care. Look, not a lot of news there, but certainly as far as a joint venture with Malaysia-based Simdam Holdings, that's fallen through. Still subject perhaps to another bid from KKR, but we have to wait and see for that one. Adam's got a hold on it, and Mark's saying it's a safe bet. He's accumulating at these levels. The first one as picked by you, Goodman Group. We've been talking about the REITs there. Mark is buying on the dip, whereas Adam is convinced it is a straight out buy. News Corp, Adam making the point it's less cyclical than expected, but he's generally not a fan of media. So he's got but he does have a buy on it, that said, as does Mark. Telstra, a change at the top there as far as the CEO is concerned. Mark's got a sell, saying it doesn't yield enough. Adam is trying to get his clients to trim it. It's a hold. And Apollo, negative. It's a double sell from both. And finally there, this Centuria Industrial REIT, a buy from Mark, a steady performer, he says, and Adam has a hold on it. All right, let's catch up with the Call's High Conviction Fund. That's picked by our investment committee. The latest episode of that meeting is live for you to watch at ausbiz.com. So let's check in, see what's going on, the movements there. Heading into September, Universal Store, NextDC, the Lottery Corp, ResMed and Oz Minerals were removed. Karoon Energy, Boss Resources, Washington 8 Soul Pats, Premier Investments and South 32 were added. So in terms of performance, it's up around 2% on a cumulative return basis since its inception at the beginning of March. So keep sending in your requests, keep the call switched on to see which stocks our committee will be looking at next.
The Last Call is brought to you by AVL Wines. Invest in the home of Australia's premium wine, spirit and ready-to-drink cocktail brands.
All right, let's get into the second half of the show. The stocks we'll be looking at: Vanguard Diversified High Growth Index ETF, Megaport, Harvey Norman Premium and West African Resources. All right, so to the Vanguard Diversified High Growth Index ETF, VDHG. Nick wanting to know about this one. So effectively it sort of functions as an ETF of ETFs,
Yep.
Adam.
And high growth ETFs. So they've basically said on the fact sheet that they've basically said 90% of the assets are in growth, 10% are going to be in income. So that's that sort of asset allocation that you'd look at it. And then talking about that asset allocation, they've got 35% of that in Aussie shares, and then around about sort of closer to sort of 45% in international shares. There is some hedging that goes in with that to make it a little bit less volatile with the currency. So you've got to be a little bit careful. That does raise up the cost because of that hedging that goes in there. But then they also then have small companies and some more index funds in there as well. So I actually don't mind these Vanguard products because I use them for clients that need growth, but we can buy a basket of goods like any ETF, and it has the ability to have that good asset allocation, but only for clients that have got a smaller balance. So if you're just starting out and you want to get something and you want to get access to a larger part of the market, sometimes these are good for that. MER, or management expense ratio, is only 0.27%, so it's actually quite low compared to other ETFs out there. So look, I think it suits a purpose for a certain investor. I don't usually do it for my larger style clients because we can go in and make these kinds of portfolios ourselves. It's not sort of asset allocation, and so it's not rocket science what they're doing. But for someone with a lower balance who doesn't really want to look at the market, wants to have that diversification, I think it's a good product for them. So you're about to ask me, is that a buy, hold or sell? Look, for a lower balance client, I think it's a buy. So I'm going to say it's a buy. But for other clients that have got larger balances, can pretty much do that and replicate that quite easily ourselves. So, yeah, it's a buy.
What is you look at your clients? What is the appetite for ETFs? Because as you say, given what you do, you can build your own portfolio anyway. Do they tend to prefer that, where it gives them sort of, they feel as though they've got greater exposure?
Correct. Yeah. So instead of just looking at one line in the portfolio, they've got, we've got Aussie equities, we've got international equities, we've got property, we've got international fixed income, we've got domestic fixed income, we've got cash, we've got infrastructure, and we can build out a portfolio. So this is what these guys are doing, making it a lot easier for you. But what we can do is then we can, not go into their asset allocation rates, we can lift things up as we see. If we like infrastructure, we'll have a higher weighting to that, and we'll be able to fine tune the portfolio a lot better, because at the moment you're in the hands of Vanguard and their asset allocation tools. So yeah, we prefer to sort of do it ourselves.
Does it come down to the client profile? Because sort of speaking to kids under 30, or at least in their 20s, they tend to like ETFs.
Yeah, absolutely. And we love ETFs as well, because what it does is that for a client, I used to only be able to look at the Australian equity market, or let's say 30% of their overall portfolio. Now I can look at 95% of their portfolio, and I can help them with full asset allocation, because I've got the tools, ETFs, to buy international ETFs here in Australia. I've got tools to buy bonds, all of those kinds of things on the market. So it does allow me to be more in control of a client's portfolio, but also then be able to get better returns for them as well.
All right, Mark, I'll get your view on ETFs in general, but specifically the Vanguard Diversified High Growth ETF. How do you look at that one?
I 1000% agree with Adam. This is not something that I'd be. This is if you've got your investing training wheels on and you want it in your smaller account balance. But look, this is ETF squared basically. And look, whilst the management fee's low, I mean they are going and buying their own funds, and then there's a fee on top of that, and then there's a spread, and then there's this, and whether. And look, high growth I think is probably a little bit hyperbolic. I mean, if it's high growth, fixed income, 10% allocation there as well. It doesn't seem that high growth to me. They've invented their own benchmark and they've underperformed it consistently. So
it has underperformed. Hasn't it?
So but you would not be able to get this on without a significant sort of sized account balance. So if it is if it's something you want a dollar average over the next 10 years as you're starting to invest, it's a useful product. But it's certainly not something. I mean, the fees would start to get up, and then you're obviously paying your broker to buy it as well. So it's not. We can definitely replicate this sort of thing, and more often than not, you'd be sort of outperforming it with the timing as well. So.
All right, so it's a no. You're just not looking at it.
No,
no. But to my question to Adam, then more generally with ETFs and perhaps the appetite as far as your clients are concerned, how do you look at them?
We will generally use them for thematic trades or mainly offshore exposure more than anything else. As far as the ASX 200 goes, we're pretty comfortable doing that ourselves. So I mean things like the triple O oil ETF's been quite kind to us this year. I think that that uranium ETF that's just come out from Beta Shares as well has got some of the producers which we don't have in Australia at the moment. Which will be when we're switching out of the next to be producers like Boss and Paladin, we can switch back into that and maintain an exposure, but it's a safer exposure because these guys are actually Cameco and things are producing. So that's where we would use those sorts of things. Obviously, we've been sort of exiting a good chunk of our short Nasdaq and short US or BBUS position over the last couple of days. Those sorts of things are where ETFs are quite useful for us. So and look and also in the Australian market when the market's quite volatile. We're big fans of gear, which is the leverage long of the ASX 200, and that's just because when it gets to silly levels to the downside, you don't have enough time to go and try to replicate that, or or do the stock picking. It's just much easier, in those fast plays to allocate capital that way. And then as you unwind it, you unwind back into the individual positions. So that's sort of how we would tend to use the ETFs. But this sort of things. You probably, like I said, for a smaller investor who wants to, accumulate dollar average, it's probably not a bad product over say a 10-year period of time, someone in their 20s or 30s or something.
Okay, let's move on to Megaport. Oscar wanting to know about this. It is the global software company. Latest results for FY22, revenue up 40%, net loss narrowing by 12%. Mark, though, you take a look at the share price, it's off by about 50% over the past 12 months.
Yeah, revenue up 40%, but operating costs up 42%. So this is not the sort of business we're really that fond of at the moment. I think in the tech space there's a lot of better picks out there as it stands than Megaport. And until they show some form of sort of, fiscal discipline, that's more in line with the economic outlook, it's not really something we'd necessarily consider. But yeah, look, and this is very volatile. It's in the top 10 or 20, highest average daily ranges as well. So you've got to be you can lose anywhere up to 10% missing an exit or entry price. So it is, you'd have to be watching it pretty closely. The analysts are quite fond of it. I'm not entirely sure why. I think earnings per share are predicted to worsen over the next 12 months as well. So it's a sell for me. If you're a day trader, it can be quite a good one to be in and out of within a very short period of time. But from an investment standpoint, it's way down the list for tech stocks that I'll be, dollar averaging back into over the next, sort of 6 to 12 months. Okay,
so Adam, Mark is sort of he's recommending it to traders rather than investors as such. Yeah. What are your thoughts?
So I'm going to stay with a hold on it. I actually like Megaport as a business. It has done well. But overall, the tech space generally reported in line with expectations, albeit there was some revisions to the downside of the reporting season. Margin pressure certainly drove average consensus for 2023 down about 7% across the industry, and the sector certainly feeling pressure around labour shortages as well as that margin crunch that we've seen. So overall, I think the sector is in a re-rate at the moment. Hence why I'm happy to place a hold on it. We do know there's private equity moving around inside of the tech space, with Tyro catching a little bit of a bid the other day. Nearmap trying to get mopped up there. And I even think Nitro got a little bit of a play as well. So there is interest. I'm not saying that Megaport is a takeover target by any stretch of the imagination, but there are private equity moving in that space and looking around at that one. For me, it's a hold. I've got a lot of clients in it. We're holding on for better times, but I think those better times are going to be end of 2023 to 2024. So we've still got some bit of water to go under the bridge before we start to see these share prices start to move higher.
When you say you got a lot of clients in it, was that because they liked it?
No. We recommended it to clients at higher prices, and then continued to buy a little bit more on the way down. And we're comfortable with it. Megaport is actually a buy rating on most brokers because of its share price where it is. We're obviously a little bit higher. But yeah, we're holding on for better days, and hopefully that comes a little bit sooner than when I quoted 2023, 2024.
All right. Okay, let's move on to Harvey Norman Maggie wanting to know about the retailer, of course. Adam, taking a look at its share price, I guess it did start to come off once those rates started rising. Of course, it is very susceptible to where they're going.
Well, it's got a large property portfolio as well, so that's certainly one of the things. But again, this was a COVID beneficiary. Big online sales.
Furnish your house.
Furnish your house. You can see that sort of that fall after, and then obviously interest rate rises as well. So strength, I guess, came from easing of lockdowns. That happened at the start of 2022. I did buy some Harvey Norman and JB Hi-Fi for that rebuild trade because we had all the floods and we had all this, those sort of things up in Lismore and those kinds of things. And I thought everyone's still got to then buy another TV, buy another couch, got to do these things. But that really didn't translate to the share price. So we've had to unwind some of those positions. The dividend yield is probably the only thing that holds this thing up and has low net debt equity as well. ROE is better at sort of 16 times. And the dividend yield isn't too bad here at sort of 8% plus franking. So for me, it would be a hold on the dividend alone. There's nothing that really excites me with Harvey Norman overall. Management has done quite well. Store network, they're only opening a couple of stores, so they've got to have that growth there. But for me, it's one of those COVID hangover businesses which I just don't think you need to be there. So it's a hold on the dividend alone.
What about more generally retailers then, how you're playing it?
So consumer discretionary retailers, Lovisa was the key and that was the standout. I really like that one. I like Uni as well, Universal. City Chic came out with something today. I think I saw something on that. We've just initiated coverage on Premier Investments and we've got a sort of decent price target on that. And so that would be my top pick in that discretionary space because you've got such diversification across Just Jeans, Smiggles, all of those kinds of things. Plus he owns 20% of Myer, 22% of Breville. He's sort of hedging his bets a little bit here and I think Premier Investments is a better call for the consumer discretionary space.
All right, it's a bit of an ETF then, isn't it, really?
Oh, yeah, there you go. Yeah. Absolutely. Spread the risk.
Yeah, right. Mark, Harvey Norman.
Yeah, it's a hold for the dividend pretty much as well. It does tend to rally quite hard into the dividend. And then if you have a look at the chart, back to the last time it went ex-dividend, it fell off a cliff after that. So, you would probably expect this to remain fairly buoyant into, I think it's the end of the month. I think it goes ex-dividend. It doesn't pay for ages either, so it's a good 4 to 6 weeks or something like that. But the key to this is basically, if you look into the retail sales numbers, they are at record highs, the last retail sales number, 34.6 billion. And but it was, to Adam's point about Premier Investments, department stores, clothing and apparel, and those sorts of expenditures, whereas spending for household fell 1.1% and it's fallen 3 out of the last 4. So, whilst you've got to look into those retail sales numbers really to know, where the actual trends are. And I think that Premier Investments is it's actually at a fairly cheap price. I was pretty fond. I thought it was very oversold. The consumer discretionary part, we did relatively well out of things like Nick Scali, Super Retail, etc. Nick Scali now essentially on its consistency is just a hold. We'll just ignore the price. It just chips away all the time. But things like Super Retail that are a little bit more cyclical, we've sort of taken our dividend and taken our money. But yeah, I would be more pushing towards where the trend in the retail sales numbers are, with that record sort of spending on the smaller items rather than the big household items. So but it's a hold. It's a consistent business with a really high dividend and look, the PE's towards the bottom third of the range. It's not expensive. But yeah, if you've got it, and I think your return on equity is pretty decent as well. I think you can definitely hold it. So.
All right, that is a double hold on Harvey Norman. On to Premium. Raju wanting to know about this, the wealth management business. Can you ask the experts about it, because it was trading higher last week, even when the sector was down. It also spiked in its recent results day. So obviously Raju is looking for the positives at the moment. Can you see them, Mark?
This space, I think this is possibly it's a bit more of a takeover target rather than anything else. I think it'll eventually end up getting gobbled up. It's a smaller player, probably prefer Hub24 maybe in the space. I think the overall industry is obviously there's been a mass exodus of financial planners, etc. So platforms like this are going to be more and more in demand. But it's incredibly high PE. They've got a buyback going on at the moment. And they had some great inflows. So I think it was 2.9 billion, 16.6 million EBITDA. But yeah, I think this will this is the sort of business that with private equity sniffing around a lot of sort of tech businesses, I would have thought this one would be a prime target. I don't like to trade off, that potential necessarily, but yeah, it's a hold for me. I think the bigger players are going to have an advantage overall, but I think there's a definite chance of it. Given that massive inflow of funds under management, which everyone's scrapping for at the moment, I think that puts a pretty big target on its back.
Okay, Adam.
So yeah, the only two suitors is Hub or Netwealth, to be honest, for that takeover. Both have got sort of in line. Both share prices of Hub and Netwealth are in line, and they've sort of got the same amount of funds under management and cash in there. So it's really going to be, and Praemium have done a really good job in cleaning up the business. They've got rid of their London or their international business. So that's actually cleaned that balance sheet. That cleans up the books a little bit for someone who potentially might want to take it over, because we don't really have any other sort of platforms left in our market. Managed accounts got taken over. There was another one that got taken over as well. So there's not much. There's only 4 players, and then you've got the BTs of the world and those kinds of things, which they're not that interested. They're still dealing with their other stuff as well. So I do think I agree with Mark that it is a takeover target, but you wouldn't be buying it for that. Certainly, we cover it at Shores. We say it's quite high risk, and we've got a buy on it. So I'm going to stay with my analyst on the buy side of things. Revenue was up 22%, but costs were also up as well. So that was sort of negated a lot of that. And it looks like that obviously, despite some good inflows from their SMAs and sort of their other VMA products, it really isn't sort of getting the market excited. But I do think that one day this thing will get taken over. So I'm going to stay with a buy on it.
Okay, that's Praemium. Let's round it out with West African Resources. Michelle wanting to know about this. In fact, it's what's now a $1 billion producer, strong cash flow, unhedged gold production, is ramping up production. In fact, Adam, how do you see this one?
So I'm going to give you the metrics first, and then I'm going to tell you, what I think about it. West African Resources, I know it very well. We helped raise money at 20 cents for this thing. I was in on this pre-IPO, so I know a lot about this business. But overall, all-in sustaining costs for West African Resources is around about $1,000, $1,100. And they produced around about 130,000 ounces last year. So some good profitability there. They've got about 300 million sitting in the bank, 208 million at the end of first half of 2022. So look, money in the bank, also in sustaining costs is pretty average. That has risen from $940 an ounce the year before. So again, the sort of higher costs are starting to eat into that margin. But overall, I think it's okay for what they're doing, and they've got cash in the bank. However, I don't invest in companies that I don't understand the geopolitical risk of the country what they're in. West Africa, and there's coups going on, there's people dying, there's all of those kinds of things. And one day you can wake up, and I can tell you many, many stories of where we've invested in companies where we don't understand the political landscape. And one day you wake up and you basically don't have a company anymore because the government's taken over or something's happened. So for me, it's too much risk or too much geopolitical risk to invest in West Africa, because there is so much turmoil and stuff and I don't know the governments that well over there also. So for me, it's an avoid. I'm going to stay away from it, albeit it is a producer, got all in sustaining costs, got cash in the bank. For me, it just doesn't meet that metric of being in a safe country where I know what's going on. So it's a no from me.
Yeah, as you mentioned, given that potential risk there, Mark.
Yeah, that's why it trades at a discount. I think it beats all the metrics across across this industry averages. And that's where it's priced in, I suppose. I'm not playing in the gold sector pretty much at all at the moment. So it's not really something that's remotely been on my radar. I think the clients that are with other advisors, I think Gold Road would be their preferred. But look, the historical correlations for the gold price have just fallen apart over the last couple of years. So it's incredibly hard to predict, and I'm not going to put my clients into something I don't have any certainty over. And US dollar keeps rallying as well, which is never good for the gold price. Interest rates keep going up, which is not good for the gold price. So realistically, it's just not a space that I'm even considering at the moment. Particularly when when you've got a battle out there for a lot of other minerals, copper, nickel, lithium, etc. There's much better places to be, to be putting your money in terms of metals and precious metals, etc. So it's just not something I don't really know whether I'll consider going back to gold unless there's something like the Ukraine invasion where it's always a very good quick trade to buy gold because it's people's default, but
even
the
then,
investment,
even then, it hasn't really
didn't
done
work.
much.
well,
did
it's,
it?
on average, those spikes last less than 14 days.
Yeah.
So
Right.
with a trading background, we were in the Northern Star and out of it within 7 trading days.
Yeah.
It was a great little profit, and we haven't looked at it again realistically, and switched back. Many of the guys switched back to Gold Road, but yeah, it's a lot of clients still think it's a hedge. I can't convince them otherwise. They may hold it, but yeah, for me, it's not really.
So it's an avoid as well.
It's an avoid, yeah.
Yep. Okay. All right. Let's sum up the second half of the show. Vanguard Diversified High Growth Index ETF. There it is, a buy from Adam. Mark, though, no. He does mention things like the fees, but generally not interested. Megaport, the tech software company there. A sell from Mark, a hold from Adam. Harvey Norman, the big retailer, a hold from Adam on the dividend alone, he says. Also a hold from Mark. Premium, potential takeover, mentions Mark. He's got a hold on it. Adam does have a buy on it, or at least Shaw's does, but it does mention the risk there. And finally, speaking of risk, certainly geopolitical risk, and also where the gold price is, or where it's not going, I should say, both avoiding West African resources. All right, thanks to our guests. Mark, thanks for joining us in Macro.
Thank you.
And Adam from Shaw & Partners.
Anytime.
Oh, anytime.
Anytime.
All right, you'll be back soon.
Yeah.
Good one. Anything you'd like us to, any stocks you'd like us to cover, just send us an email, the call at ausbiz.com.au. You can tweet us at ausbiztv, and you can find those stocks in the calls portfolio. Head to ausbiz.co/portfolio. That's the show. Thanks for watching.
The Call is brought to you by CMC Markets, a world-leading online trading platform for CFDs and shares around the globe.